Hello everyone, this is Charlie Stryker. I'm going to be touching on Chapter 12, Section 3, A through E. It's going to be talking about some operational rules for S-Corps. What we're going to be touching on today is the computation of S-Corp taxable income and types of income that there are. We're going to talk about how the qualified business income deduction affects S-Corp taxable income, income and loss allocations, among shareholders for S corps and what the short year election is for an S corp. And then the big chunk of it here on the back end is going to be a lot about the tax treatment of distributions, how they're going to be handled. You'll see it's kind of similar to C corps in some ways, uh, as well as the tax schedule, specifically M2 and M3, and how distributions of non-cash items like property are going to be handled. All right, so let's jump into it. So we got the computation of taxable income. You're going to find that it's a lot like a partnership with some C Corp stuff mixed in there. A few differences from a C Corp is that they have to amortize organizational expenses, similar to a C Corp. Going to recognize the gain but not loss on distributions of appreciated property to shareholders. You're going to see how we talk about that here at the back end of the presentation. There is no dividend received deduction, so that is different than a C Corp. And then certain individual deductions are disallowed, and those are going to be the deductions like alimony payments, personal moving expenses, dependent care expenses, the personal exemption, and the standard deduction. All right, so jumping into the types of S Corp items, there's going to be two non-separately stated items. These are going to be items that contribute to ordinary income or loss for the S Corp. So anything relating to more or less the operation of the company. And then you have separately stated items. This is going to be a little more of an in-depth list here. Those are items that can affect shareholders differently depending on their tax situation, what tax bracket they're in, so on and so forth, if they're married, if they're single. It's going to be identical to the separately stated items for a partnership, and these will be listed on Schedule K, Form 1120S. Now I'm going to run through the list of what these are. It includes tax-exempt income, long-term and short-term capital gains and losses, Section 1231 gains and losses, charitable contributions, passive activity gains, losses, and credits, certain portfolio income, Section 179 deductions, tax preferences and adjustments for the shareholders' alternative minimum tax, depletion, foreign income and loss, recoveries of tax benefit items, intangible drilling costs, and investment interest income and expenses. All right, so coming into the qualified business income deduction, this is set up to make S Corp taxes closer to the new lower C Corp tax rate. So if you're taking the full 20% deduction, that's going to bring the S Corp's effective tax rate down to like 29.6% if you ignore all the other taxes, like payroll tax. Now there are some limits to this. So certain S Corps can deduct up to the full 20% of qualified business income, but there are the limitations. You're allowed to deduct the lesser of 20% of qualified business income or 20% of modified taxable income. Now that cannot be greater, if we're talking about the upper threshold here, than 50% of the shareholders' allocable W-2 wages or 25% of W-2 wages plus 2.5% of unadjusted basis and qualified property. That's really going to depend on what type of business you run. Is it employee intensive? Is it more machinery intensive, or just has a lot of assets involved with it, and so on and so forth. All right, so the allocation of income and loss, non-separately stated items or income and loss are separately, and all separately stated items are assigned pro rata among the shareholders. And this is going to be based on the shareholders' owning percentage across each day of the year. So if you buy in on the third day of the year, let's say you buy an extra 5% on the third day of the year, you've got 362 days of ownership of an extra 5% and 2 days of the year with whatever your ownership was before. Now on the date of transfer of that stock, the person who owned the stock originally is listed as owning the stock. So even though you bought the stock in the morning on the day that you bought it, it's still deemed as being owned by the transferor. Now, short year election. Let's say that someone sells off all of their stock in the company or someone passes away, all of the shareholders in the corporation can come in to elect to treat the tax year as 2 years. So middle of the year in June, someone sells off all their ownership. Everyone can get together, decide that they want to just treat that as a separate year. And so what this does is it allows the opportunity to shift income across the between the 2 years. So instead of allocating the income or loss at the end of the year evenly across everyone, including the guy who'd sold off his share, you cut it off and take everything from the first half of the year and apply it to that group, including the individual who sold off. And then at the back end of the year, whatever happens gets applied among all the folks who are not including that individual who sold off. So it allows you to take a bigger share of loss in the back half of the year than it would if you had to share it with someone who sold their interest of the company off earlier in the year. All right, so the tax treatment of distributions to shareholders. So it's going to be equal to the cash and the fair market value of the property distributed. So that's going to be your taxable income there. It's going to depend a bit on whether or not the S Corp used to be a C Corp or not. So if there was that accumulated E&P, as we were used to with the C Corps or not, is going to dictate exactly how the distribution is handled. So if there was no E&P, the distribution is going to be tax-free up to the shareholder's stock basis, and then once you deplete the full stock basis, it goes to zero. After that, it becomes a gain on the sale, capital gain. Now, if there was some accumulated E&P, then the treatment is going to be to treat it like a dividend until you exhaust the E&P. So very similar to a C Corp in that respect. Now, how accumulated adjusted income is going to be treated is that it is you are required to track previously taxed S Corp income if you were previously a C Corp, but everyone should really do it. As you'll see here in a minute, when S Corp is established, your accumulated adjustment income starts as at zero on the first day of the S Corp's first taxable year. And distributions from this amount are going to be tax-free. And the reason for this is because what the accumulated adjustment income tracks is it tracks income that has been undistributed previously, but has already been taxed. So any undistributed separately or non-separately stated items that have already been put through the tax get distributed to the shareholders tax-free to avoid double taxation like in a C Corp. Right, so what drives up and down accumulated adjustment income? Well, it is increased by Schedule K income that is not tax exempt, depletion in excess of property's basis, and non-separately computed income. And it is decreased by Schedule K losses and deductions and any portion of tax-free distributions from AAA. And you cannot go negative on AAA from distributions, but you can from losses. All right, so let's jump into the order here. Before I continue, I want to just clarify that AAA, whenever I write AAA, that means accumulated adjustment account. So there's an order for distributions from an S Corp. Your distributions are first going to come out of AAA. All right, so those are going to be tax-free, as we discussed. That's the accumulated adjustment account. Then they're going to come from accumulated E&P, and those are going to be taxed as dividends like a C Corp. Now, you can elect to take it from AEP first if all the shareholders agree. That's good if you want to deplete a small balance in accumulated E&P. So you just clear that out and then move on to the AAA. After you've gone through the E&P, you're going to take it from the other adjustment account. I'm going to talk about what that is in a second here. It's generally tax-free. Other adjustment account is going to And the other adjustment account is going to include items that affect basis but are not in the AAA account. They're going to be like tax-exempt income and related non-deductible expenses like life insurance proceeds or insurance premiums paid. Once you've depleted the OAA, you're going to take distributions from the shareholder stock basis. So very similar to things we've seen before. It's going to be treated as a tax-free recovery of capital. And once you've depleted their basis, then you move on and treat the remaining distributions as capital gains. All right, so let's jump into the tax schedules here. So you've got the Schedule M2. That's where the changes to the account is going, the AAA account is going to be reported. And this is also going to contain that column for the OAA stuff as well. So everything I talked about in the last slide, that's pretty much all going to show up on Schedule M2. Now, Schedule M3 is required for S Corps with a $10 million plus balance in their asset accounts. So if they have a $10 million or more in assets, they have to file a Schedule M3 in lieu of a Schedule M1. And this is going to be used by the IRS to target specific items in the audit because if they do audit them, because it is going to detail differences between book and PACs. Now, S Corps, let's say that an S Corp decides to terminate its status or is forced to terminate its status. Distributions up to 1 year after termination can be treated as a tax-free stock basis recovery to the extent of the AAA account. You must know your balances in those accounts in the AAA or the OAA to elect this, but that is a favorable tax status if you change over to a C Corp and decide to have distributions and don't want them treated as capital gains or dividends. As dividends, distributions, you have 1 year to take these as tax-free stock recovery. All right, let's jump into the final slide here, which is going to be gain and loss property here. So distribution of property to shareholders is going to be treated as if the asset was sold at its fair market value. So the S Corp is going to recognize a gain on the distribution of appreciated property. That gain is going to be passed through the shareholder, and it's going to, whether it's capital gain or ordinary income depends on the nature of the asset. And the reason why this is set up is so that it doesn't get passed on to the shareholder and enjoy that step up in basis, because the shareholder assumes it with a basis that is fair market value, and then they can sell it tax-free later. So that's why there is a gain recognized when it's passed on. Now, in lost property, there's no loss recognized when passing lost property onto shareholders. So it's something that should be avoided. The shareholder's basis is going to be the fair market value, so it's a step down basis just as it'd be a stepped up basis in the gain property. And so your loss is actually going to be postponed until you potentially sell the stock in the future. So it's better to just sell the lost property off and then distribute the income to the shareholders instead of giving them the lost property. All right, so what we touched on today was the S Corp taxation is kind of a mix of C Corps and partnerships. There are two types of tax items for S Corps. There's going to be the separately stated items, which we listed earlier, and the non-separately stated items, which are going to be tied into the overall income there. We talked about how the QBI deduction applies to S Corps and why. I thought it was interesting how it was set up to make it a little more equitable tax favorability between S Corps and C Corps. And that the income is allocated across the shareholders pro rata. So, it's going to be a day-per-day thing for shareholders if you buy more stock or sell some stock, that your shares are going to be calculated on a day-per-day basis, with, of course, the day of the sale still counting as you owning it. And then the short year election we talked about and how that can affect taxability. And we talked about the distribution orders of going through everything, very similar to C Corps in that respect, with a few more extra steps. And then the structure of gain and loss property and how it can avoid tax-free treatment to shareholders on gain property, so that you're not just stepping up your basis and then selling it when it's free. All right, and that's everything. Thank you everyone for listening. All right, and good luck to everyone.